Hello everyone, this is Juan Sarmiento and today is Friday, January the 27th. I have a couple of trades suggested for you today, but before we do that, let's look at our current trades and see if they need any adjustments. Let's get started with Adobe here. Let's go to the Analyze tab and just give our space here. I have February 17 rather, and March 17. Right, rare combination, but doesn't matter. You can always roll this, but it's too early for the February. If you take a look at the Add Simulated Trades, I don't remember why I did that, but I must have had my reasons. We can easily deal with that. Think of it as the 17th has 21 days to go, and it will erode. Perhaps the put side was easier to fill than the call side. The stock is trading above 350 now, and perhaps it wasn't that before. Yeah, it's been taking off here, as you can see, and that's good because we have positive deltas. Not that it matters much. What we're looking for is for the price to go above the smiley face, somewhere in around 374, before we start taking profits. If the stock collapses from here and lands exactly at 350, we'll be happy too. Okay, so no need to change anything. As we get closer to February 17th, then we will roll up the put. Okay, for now, no need to do anything. Let's go to Caterpillar, and we are here. This is our current price, and as you can see, it is way up here. Our call, we had done a roll up to 260, but now take a look at how many calls we have. 2 here, long, 2 short at 220. It doesn't matter, that's so far out of the money. Eventually what would happen is that we would be assigned the short calls, and then we get the short stock, and then we use our long calls to cancel that out. The puts will be left behind. The only thing that matters here is the 260 here, and because the stock is well above 260, look at the smiley faces around 50. Well, you keep on taking your profits as the stock moves up. All right, perhaps you want to close it all together. That will be fine too, but I don't want to close it when the stock is moving in our favor, making new highs. Earnings are coming up, so it is a good idea. That will be next week, Monday, before the market opens. So what we need to do right now is to roll this up and try to neutralize my deltas as much as we can. So I'm going to roll it, analyze rolling. All right, and let's say we are closing our long 260 call expiring on the 17th, and we are buying at a higher strike price, could be 265, and same expiration, the 17th. Okay, and the delta is still pretty high, so you can go to 270. Okay, you're not gonna make, what you want is neutralize your delta really. So let's go to 270, and of course you make more money, and now your delta is 27. I think 275 is probably too high. 17 deltas, yep. Let's do just that, okay? It's in the odd chance that this stock continues to above 275. Yeah, it essentially is you're closing the position more or less without having to close every single leg of it, because they're more or less neutral. If you were to select only the put side, the put side looks like this, and you might want to close it. Calendar put side, that's 18 cents, because you're selling for is 69 cents. okay, and that will close that position. The call side is 2, okay, 2 at 220, and we have 220 for the 10. We're closing that, and we're closing the 17. That gives you 35 cents, okay. You know, because earnings are coming up, we can close everything. How about that? We have made plenty of money on this trade. So let's start by closing the put and get 138 back. And then the call side, the call calendar, confirm and send that. And then when all those get filled, because they're harder to fill, they're so out of the money, then you can sell this. And then if the stock rallies up on Monday, you can enter a new trade. Okay, let's move on to CRM. CRM is getting really close to the is in the bottom here of the smiley face. If it goes higher above that, then great, we can start taking profits. For now, 17 is no rush. And if the stock was to collapse here, which it doesn't seem like it's going to go down, this is a weekly chart. Let's put a daily chart. Yeah, it seemed like it's going to go higher, so let's leave it alone. That's a good way to make money on the call side. It's 33 deltas. Cisco, same thing. February 10th, that will be next week, wouldn't it? No, 14 days to that. So let's go to the Analyze tab, risk profile. Yeah, that seems okay, all right. It is at the smiley face, so we don't really care if it goes up or low, higher or lower. You can sell one call in order to neutralize, but it's so bullish. The market is so bullish right now. You'd be concerned about the earnings. Yeah, I think we're going to leave it alone. It seems like it has some room to go until next week. Let's go to Gilead. And Gilead has been going down, but I think it's done correcting. Earnings are coming up. All right, let's take a look. Analyze tab. Yeah, we are, you see, this is the only way I will go over earnings. You need to neutralize your delta and make sure that you are above. That's the Caterpillar. That's the call side. Okay, so let's sell one call here for the Gilead, and I'm going to sell one of the long calls. Just sell one. And yeah, I don't like that, because then, yeah, I want it here exactly where it is, at the middle, in the middle of the smiley face. Okay, so changing that, change this character of my trade. I think it's going to go up from here. That's just my impression. The stochastics is crossing this. The TTM squeeze is pointing downward. Yeah, I'm going to leave it alone. Okay. Let's go to GS. This is a bearish trip, pretty much bearish. Okay, let me take a look at the chart. Yeah, this is bouncing from earnings. Did it actually make a good earnings? No, it was actually quite bad. But you can certainly neutralize. No, I don't see a path for neutralizing this. Let's leave it alone too. February 10th, that's not next week. We have 2 weeks to go on that one. Let's go to TSM. Yeah, that's excellent the way it is right now. Okay, this is a trade we entered last week. Okay, the two trades that I want to consider is STX is one of them. Yeah, and the other, I forget what it was. Let me see. If we delete this here, we should show everything. There we go, show that everything. I'm just gonna scroll down. These are all trades that we never got filled. We have them there. Here it is. COF is the one that I want to consider. COF. Okay, let's start with COF, if you don't mind. Okay, this is the original trade. It's already gone up. Okay, so it's closer to 120, so we can change that. Let's consider both. The 115 and the 120. I think 120 is closer. Yeah. Okay. Okay, let's consider this 120. There, it's a little cheaper too. Okay, so the first thing, let's look at a quick chart, and you can see that it's been going up after earnings. Earnings came in well ahead of expectations. No, quite the opposite. But it jumped anyway, and the volatility has dropped significantly. It's now here at 33. Live News will tell you the reason for their stock jumping, and if it is something like going forward they are expecting better quarters, rather than the wimpy underestimates, then it is a good stock to consider. It says outperformed by other financial institutions. So make sure you read the news like this and look for a reason for the stock to have jumped the way it did on the earnings day. That was rather remarkable considering that they missed. And then they have adjusted estimates, and that's the kind of thing that would jump, but I'm not too impressed. Okay, so the earnings not very surprising here. They just says miss estimates. So well, how come it's going up anyway? Yeah, here it is. The earnings, revenue, whatever. 8% increase. 8%, yeah, that's... Yeah. Okay. Let's do it anyway. It's jumped 10%. Let's see if everything else checks out. Let's go to the Analyze tab, and then we see the volatility. You need a calculator for that. And you calculate the average for the June, which is quite a ways away, but that's the one that is the least, the closest to more than, it needs to be more than 90%, 90 days to expiration. So 34.85 plus 28.52, in case you wonder. Here is what we're calculating, all right? The two long options, the long puts and the long call, the long calls and the long puts, you average those divided by 2, and that gives you 31.6. That's a percent data, okay? Percent volatility. Let's clear the memory and add it, and then we calculate this one, which is the shorts, 31.01 plus 32.44 divided by 2, and then we subtract that from memory. So let's press M minus and then MR, and you see that is practically zero. So that means that the volatility, there's no volatility skew. The volatility of the front month is very similar to the volatility of the back month, and that makes for a great candidate. Okay, let's go to the trade tab now and go to all products and look for COF and look at the current IB percentile, 0%. That means that is at the lowest point of volatility, which is exactly what we want. We want volatility to be as low as possible. Why? Because a little increase in the volatility, let's say we entered the trade at $30, and now all of a sudden the volatility increases even by 1%. Oh, that's curious. You enter here 1%, okay? There, 10%, there you go, 1%. And just that, and then you're in the profit column, okay? If it really goes up, like 15%, when then you are in the money, you get into the thousands. Not that it will happen, but if it ever goes to something like 30% increase in volatility, bingo, then that's a big winner, okay? That is regardless of whether the stock goes up or down, just by virtue of a volatility increase. If the stock doesn't do that, but it simply goes up, let's see, neutralize that. And let's say the stock goes to 135. Then you begin making money on the, of course this would change because the short calls will begin, the short options will begin to lose value, okay? And that's, you make money that way. Okay, let's go to the last thing we need to calculate is see if this is a fluid trade, liquid. So we are going to say create duplicate order, and now you have mid and natural, and you're going to use the calculator again and subtract the from 30.75, that's your natural, the price here at the bottom, okay? And subtract, take away 30.08 and divide that by 30.75, and that's in percent basis, that's 2.1, okay? That's less than 3%. I use that as a rule of thumb, okay? If it varies a little bit, well, then you acquire sort of experience on what to do and what not to do. In my experience, less than 3% is fine. Okay, so I'm gonna do that. 3.10, and now we just calculate what the price we need to, when we create the duplicate order, confirm and send, and then you can calculate how much am I willing to spend? Well, about 10% of my account. That is $9,663. Okay, so then let's say multiple accounts, and then we figure out this is our account, and I'm gonna increase. Yeah, I'm gonna do 3 lots, and that should be enough, which means 6 long calls, 6 long puts, 3 short calls, and 3 short puts. And that's our trade. Okay, we'll wait until it gets filled. In the meantime, let's go to STX Seagate Technologies. That's correct. Okay, so here, that's a little, okay, let's do the same calculations. First of all, open that up. Make sure you're very close to the strike price. The current price is only 40 cents away. Great. Let's look at the chart. and they reported earnings of 16 cents, and that came well ahead of expectation. They were expecting a loss, they got a gain, great. The volatility also has dropped to below, it's about 39, it's at the bottom of the range for this stock. You can take a look at the trade tab and again scroll down and you see 11%. If this is 15, I'm content. 11 is great. 0 is make me very happy. Okay, so here we go here, and the earnings are good. The volatility range is good, it's low. The stock is moved more than 10% over the last little while. And the volatility, we calculate that again. Let's get the calculator, clear the memory, and again, we go 39.08. Just focus here on these numbers. We are collecting the volatility for the long calls and long puts. Okay, so 39.08 plus 30.54. Okay, divide that by 2 and memorize it. Memory clear, add it. And then we do that same calculation for the short. Here, the last two here, the short options. 36.96 plus 30.62 is 67. Divide that by 2, and that's 33. And we're going to subtract from what we stored in memory, which is the average for the long. Just click on memory minus, and then memory recall gives you 1%. If that number is more than 3%, I'm happy. Okay. The only thing we're missing is the liquidity of it. Okay. Again, calculator. And in this case, okay, we say create duplicate, and we are going to calculate the natural, which is 18.87, minus the mid, which is 18.15. Again, look at the bottom here. And then sub equals 0.78, 0.72, and divide that by 18.85, and that's times 100, that's 3.8. It's sort of a little too much, okay, but I'm fine with that. Everything else seems to check. I'm going to, you may have troubles getting in and getting out, that's all, okay, which means you could lose profits. You could lose profits trying to get out. You would then, because your trade doesn't get filled, you reduce the price indefinitely, and then there is too much shaving of your profits if it is hard to get out, and then you're desperate to get out, and then it doesn't feel good. Okay, let's enter this, create duplicate order, and how many are we going to make? Well, confirm and send multiple accounts so that you can see exactly how you can change the quantity and what the buying effect is. And we're going to go to 9. Yeah, 6 is too many. 9, 5 lots give me a cost of $9,000, which is about 10% of my account. I'm going to send that off. Voila. Okay, so we wait for that to fill, and if it doesn't, I would increase my debit until it gets filled, because we already decided we're going to trade. And yeah, sometimes if I feel that I'm raising it and nothing happens, that's the liquidity issue, and then I might decide not to enter it at all. Well, let's go and check it out. What happened? Okay, we had this Caterpillar position filled, and now you see I'm asking for too much compared to the 66. Okay, so cancel, replace, unlock, confirm and send. If it doesn't get filled, try again, and get filled. Now we can see we only have that long call left. Okay, you can say, well, how about, why don't you just sell a option against it? Well, then you have a vertical. If you're wanting to do that, you can do that now. If you are considering that, let's say 62.5, you get $9 and that's your trade, and you don't lose money, you lose your profits. Okay, I'm just gonna get out. I don't wanna, it's like a waste of time for me. There you go. Confirm and send. And we're gonna get $1,000 out of that. And then in the end, whether we have profits or not, well, you can evaluate that. All right, let's go back to the monitor tab, and we're gonna adjust our trades here to make sure that we get them filled. Okay, as you can see, both of them are above the current market price, so they should fill. You just have to be patient to see if they do. Let's adjust this just a bit, cancel replace, and increase this by 5 cents at a time, or 3 cents, that's up to you. It just takes longer that way. And because they're a little wide, both of them are a little wide, the first one, COF, it wasn't supposed to be that bad. It should have filled. Let's continue on. Okay, now it got filled. And that was the COF at 320. Of course, you can push it all the way to the natural, but I'm not going to do that. I want to sort of play it until I get filled. So to get the best price possible and get filled at the same time. Okay, I'm going to continue on my own, and so I'm going to call it a day here, not to waste your time. Thank you very much for joining me, and see you next time. Bye-bye.